Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer over at Sanctuary Wealth. We're going to cover how the markets are reacting to the FOMC decision and earnings. Jeff, there's so much to unpack for this week, January 2022, just in general, but how do you think the markets have digested what we heard come out of the FOMC and, of course, Powell's comments about policy moving forward?
Well, Jill, I would flat out say the markets are confused. It's almost dizzy to a certain extent when you're seeing the Dow Jones move 1,000 points a day, really trying to decipher what the Federal Reserve is trying to put out there. Let's rewind. We had a nice Santa Claus rally. Things were looking pretty peachy and rosy to start 2022. And all of a sudden, the Federal Reserve and their rhetoric became really hawkish. We saw yesterday the release of the Fed meeting. Initially, it was received as quite dovish. And all of a sudden, during the actual interaction at the podium, the live Q&A, got more hawkish. So we saw volatility. The VIX is touching up around 30. But I think this is really kind of a fascinating moment in time because we're in the midst of earnings. We just had GDP growth, which actually beat expectations. We had expectation of Q4 GDP at 5.5%, came in at 6.9. So growth is there. Earnings are there. No one's talking about buybacks. I'm more optimistic despite the fact that typically when you see that type of volatility, swings of the Dow Jones of 1,000 points a day, that really reveals a crisis, Jill.
Right, but when we talk about the Fed raising rates, we're at zero right now. Historically low rates. So if they take it up 2, 3, 4 times this year, I don't understand why the economy or the market won't be able to digest that. We're historically low rates. What's another 25, 50 basis points? Why do you think the market has these tantrums like it does?
Well, I think there's such sensitivity to interest rates and more of the fact, to your point, we've become conditioned. The market's become conditioned. We're addicted to these low rates, these zero rates. So now all of a sudden, the 10-year note starts the year at 1.55%. Some people are talking about going over 2%. I'm not in that camp. I'm also in a very lonely view. I saw the Fed only raising rates once, Marches for certain. Now I only see it happening twice. And why is that, Jill? It's due to the fact that I see inflation reversing course. I think we're going to have inventory gluts. I think the used car and new car market is really going to be a factor, which is going to make the Fed maybe less reactive. And lastly, I think the Fed has finally figured out that their balance sheet, which is now $9 trillion, they may not need to raise rates 4 or 5 times like some of the street are predicting. I think they raise them twice, and then they have their balance sheet. They can synthetically raise rates by reducing that balance sheet, not allowing some of those asset purchases to run off. Maybe it's $50 billion a month like they did in 2017. But at the end of the day, I think the one thing is that the balance sheet is still going to be $8 trillion by the end of the year, Joe. That's wildly accommodative.
Right. And I think it's a good point that you bring up when you talk about supply gluts, because we are going to see that shift of spending on goods into services and experiences. I can tell you, my household, I cannot wait to get back out there and travel and not necessarily have to buy things for the house, but to go out and have experiences. And that's going to help to alleviate some of these supply chain concerns that we've seen that are causing prices to skyrocket, labor to skyrocket, and why we do have an inflationary issue now.
And that's been really hard to measure, right, Jill? Because we had Delta. All of a sudden, this reopening trade, those supply chain issues that were coming back, or that transition, like you talked about, of the consumer behavior going from goods to services, that got clouded, a little ambiguous. Now, all of a sudden, Omicron, which really wasn't in the data when you talked about the last Fed meeting, and now all of a sudden we're trying to decipher, and we were surprised to see the GDP growth as strong as it was inside of Omicron. So I think that component of businesses ordering inventory gluts in conjunction with the goods and the services moving, I think people are going to be surprised how quickly inflation, which is at 7% right now, how quickly it drops. And that's going to put the Fed on pause of interest rate hikes, but it also is going to be creating a lot more turbulence. And this is all going on during the 2022 midterm election, which historically you see this type of volatility all the way until that Q4 when we have more certainty on the actual election.
Right. And let's keep with that theme with Omicron, because as you and I are very well aware of, things were feeling very back to normal towards the end of November, middle of December. And then we had to flip that switch again, where we went back to semi-restricted environment. So while Q4 might have been good for earnings, I think it's really guidance that matters, because that spending, the shift in hours where there was labor shortages and so forth because of Omicron, that's going to start to be reflected in Q1. So it's almost like the market and the economy and the data that the Fed depends on is lagging a bit here with reality.
100%. And a real myopic view is Microsoft, right? We initially saw Microsoft earnings come out. They sold the news, but all of a sudden the forward guidance from Microsoft was really quelling to the marketplace, and ended up seeing Microsoft move higher, not just in after hours, but the next day. So a lot of volatility to decipher, but I think you're really focused on that forward guidance that's going to help us get through this. And I think Omicron is not going to be as big a distraction to the consumer as we initially anticipated, but you're absolutely right. This form of normalcy, we're going to see how we get back in transition because there is a lot of pent-up demand, and I'm counting on that pent-up demand to really help us continue with our growth.
Right. And I'm curious to see what Apple has to say tonight when it reports earnings, because there's a couple of things going on here. Of course, you have the consumer side of the business, and we want to see what demand looks like. And then, of course, the supply chain issues that tech companies are facing is the other big heavyweight when you think about all the factors going into earnings. So, quick take on Apple going into the print.
Well, the broader swath of FANG stocks, we've seen a lot of selling pressure, a lot of valuations reset, but I'm optimistic on Apple. And what's one thing that's kind of lost, we've been so focused on semiconductors and chips, not in cars, but we've had no problems with chips and iPhones. You can walk into an iPhone store, Apple store today, and buy a baker's dozen of Apple iPhones 13. So I'm optimistic where Apple is going. It's become more of an essential theme. During the lockdowns, during COVID-19, we consume more and more, and people got pushed further into the Apple ecosystem. I look at my bill every month, Jill, and I'm buying more and more on Apple, using Apple Pay. So I'll be interested to see on Apple how their services perform, and I have high expectations. So I think it is going to be embraced here by investors. I see Apple moving higher.
All right, Jeff, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.